We'd like to welcome you to the Stefanutti Stocks Interim Financial Results webcast for the 6 months ended 31st of August 2019. This presentation is also available on our website. I would like to start the presentation with an update to our funding plan. When we went to market in May 2019, the current funding gap was 400 million rand. During the current reporting period, the large public sector power project client has adopted a more intractable approach to certification of applications for work done, which has led to a substantial increase of internal funding required for the completion of this project. This project continues to place significant pressure on the group's current liquidity position. In addition to the IAS 37 provision of 263 million raised in February 2019 for the potential unrecoverable preliminary and general costs, a further provision of 462 million has been raised for potential unrecoverable costs for measured works to complete the project. The 592 million rand shown on the slide includes a difference already accounted for in the prior year as explained in the footnote. The group has made a provision of 114 million rand for the payment of advisory fees for the remainder of the financial year. This has placed an additional burden on the group, increasing the initial funding requirement of 400 million rand to approximately 986 million rand. On the 26th of July 2019, shareholders were advised that 120 million rand, referred to as the first tranche, had been received by the group as part of the specific ring-fence project funding forming the first portion of the original funding plan. Due to the additional funding required, as mentioned, the group embarked on a process with its primary banker and guarantee providers referred to in the presentation as lenders. The lenders have provided the group with additional short-term funding amounting to 391 million rand, referred to as the second tranche. This was received on the 5th of November 2019. These funds have been utilized to meet the group's short-term liquidity requirements, which allows more time for the group to resolve its contractual claims on the public sector power project. We anticipate the claims process to be substantially resolved by interim's financial year 2021. This short-term funding carries the normal terms and conditions applicable to loans of this nature. We are continuously exploring and evaluating long-term cost-effective funding solutions. The group remains in discussion with the lenders to secure additional tranches of funding. A strategic restructure team has been appointed to assist with the development of a turnaround strategy referred to as a restructuring plan and the securing of additional short and long-term funding. The successful conclusion of the short-term funding is a prerequisite to obtain the required long-term funding. The restructuring plan will consider the sale of non-core assets, including divisions or subsidiaries, and capital structure analysis, including the possibility of raising new equity, and internal restructuring initiatives required to restore optimal operational and financial performance. Once finalized, the restructuring plan will be considered by the Board of Directors for approval. Thereafter, shareholders will be updated as to the proposed plan and the anticipated timing of the implementation thereof. The continuing adverse market conditions, the necessity to joint venture, and the impact of the public sector power project has reduced revenue from operations to 4.4 billion rand when compared to the 5.1 billion rand reported in August last year. The group incurred an operating loss of 973 million rand compared to last year's operating profit of 125 million rand for the same period. The influencing factors on the operating loss will be discussed in more detail on the next slide and later in the presentation under the respective business unit reviews. The financial indicators will be covered by Antonio later in the presentation. Management and staff remain committed to enhance health, safety, and environmental policies and procedures, and together strive to constantly improve the group's health, safety, and environmental performance. The group's lost time injury frequency rate at August 2019 was 0.01, down from the 0.02 in February, and the recordable case rate was 0.31, which is an improvement from the 0.36 in February. The group is now a Level 1 broad-based Black Economic Empowerment contributor, measured in terms of the construction sector scorecard, with a Black Economic Interest score of 58.1%. I would like to give context to the operating loss. Provision for future costs. The IAS 37 provision of 462 million, as mentioned earlier under the funding plan, has been raised for potential unrecoverable costs for measured works to complete the large public sector power project. This has negatively impacted the results of the building business unit. Provisions for slow-paying trade receivables. Due to less frequent and reduced payments being received from local and cross-border clients since the beginning of the financial year, specific provisions have been raised to the value of 331 million rand. The recovery of these amounts will continue to receive management's full attention. Project losses. During this reporting period, there were 6 loss-making projects to the value of 260 million rand. I will discuss these project losses under the operational overview of each business unit. I shall now discuss the performance of the individual business units. Construction and mining contract revenue decreased to 2.6 billion rand compared to the 2.8 billion rand in August last year. The operating loss of 421 million has been impacted by the following. Provisions raised for slow-paying trade receivables. Roads and Earthworks, a South African client where payment of 70 million rand was anticipated in July this year. Mining services. 2 junior miners, one went into liquidation to the value of 62 million rand and the other defaulted on their payment terms of 30 million rand. The liquidator is taking longer than anticipated to assess our claim. With respect to the second debtor, we had debtor's insurance. However, the insurer has repudiated our claim. We are challenging this. The governments of Zambia and Nigeria, 104 million rand and 65 million rand respectively, have been provided. Project losses. Roads and Earthworks incurred a loss on one of their projects in the surface mining infrastructure sector. This project is complete. Mining services are currently mining for Keaton Mining at Fontaine, which is wholly owned by Westcal. The full operation was taken over from Lavera Mining on the 1st of February 2019. In terms of Section 197 of the Labour Relations Act and on the insistence of the unions, we took over all operators. A group of employees not satisfied with the agreed terms and processes embarked on unprotected industrial action. During the industrial action, a number of key items of essential mining plant were burnt beyond repair and intimidation of the remaining workforce occurred. A court interdict was obtained, declaring the strike as unprotected, and these striking employees were dismissed. Due to continued threats of violence and in agreement with the client, community and union, all operators were reinstated in May. Notwithstanding this action, the operators remained uncooperative. As part of an agreement with the union, we engaged in a voluntary separation program which was accepted by approximately 30% of the operators. The process of replacement of these operators took approximately 2 months and has just been concluded. The operators' attitude has improved since the voluntary separation process was concluded. Uncooperative operators, combined with lower than expected availability of third-party equipment, have resulted in ongoing operating losses. We are working closely with the client on interventions to improve operations and productivity. These interventions are starting to show positive results with improved productivity, and we expect this project to return to profitability before the end of the financial year. Civils incurred a loss on one of their projects in the industrial plant sector. This project is complete. Percentage turnover and order book by sector. The yellow indicates the turnover to August, and the blue indicates the current order book within the various sectors. Surface mining related services and transport infrastructure remain the major source of work in construction and mining. Opportunities. In the transport infrastructure sector, Sunroll has released a number of tender inquiries for road rehabilitation in the KwaZulu-Natal and Eastern Cape regions. The upgrading of the Cape Town and Oliver Tambo international airports. These will offer opportunities for the roads and earthworks and civils divisions. Port upgrades in Durban and Cape Town offer opportunities for the marine and civils divisions. Opportunities exist in water and transport infrastructure in South Africa, Swaziland and Botswana. Surface mining related services continue to present opportunities to the benefit of this business unit. Due to funding constraints in country, fewer opportunities exist for the Zambian operation, placing pressure on this division's order book. Construction and mining's order book at August 2019 was 7.5 billion versus the 8.5 billion in August 2018. In the short term, there are potential awards to the value of approximately 3.6 billion rand, and for the next 12 months, projects to the value of approximately 26 billion rand have been identified. The building business unit's contract revenue reduced to 1.4 billion when compared against the 1.7 billion in August 2018. The operating loss increased to 494 million rand and has been impacted by the following. Provision for future costs. During the current reporting period, the client has adopted a more intractable approach to certification of applications for work done on the large public sector power project. This has led to a substantial increase of internal funding required for this project. Although the group has initiated a dispute process with the client to pursue its contractual rights and recover the amounts owing to it, this has placed an additional burden on the group as mentioned earlier. Consequently, in addition to the provision of 263 million raised at February 2019 for the potential unrecoverable preliminary and general costs, the group has now raised a further provision of 462 million rand for the potential unrecoverable monthly measured works to complete the project. Construction of this project is programmed to be completed by December 2020 and the end of commissioning by December 2021. Engagement with client. With respect to the large public sector power project, we have recently had a positive engagement with this client's top management. Subsequent to this meeting, constructive and encouraging engagements are continuously taking place with the client's site management teams. Project losses. The Gauteng division reported a loss due to a loss-making project which is now complete, and together with retrenchment costs and holding costs due to insufficient work. The profit of the 15 million rand of the equity accounted United Arab Emirates operation is excluded from this result. The Mozambique and coastal divisions continue to deliver positive results. Percentage turnover and order book by sector. 81% of the current turnover was in the office and commercial and factory and warehouse sectors. In the current order book, office and commercial and shopping and retail make up the majority of the work secured. Opportunities. The building sector within South Africa has recently experienced an increase in tender activity, offering opportunities for this business unit as follows. Public sector and social housing in Gauteng and Western Cape. Commercial, leisure, warehouse and factory in the private sector in KwaZulu-Natal and Western Cape. The upgrading of Cape Town and Oliver Tambo international airports. The Mozambique division is pursuing opportunities in office, residential, factory and surface mining infrastructure in the private sector. Buildings order book at August 2019 was 2.5 billion rand, excluding the United Arab Emirates order book of 974 million rand. Just to clarify, the UAE is included in the order book, but due to the fact that it's equity accounted, its turnover is excluded from contract revenue. In short, there are potential awards to the value of approximately 3.5 billion rand, and for the next 12 months, projects to the value of approximately 16 billion rand have been identified. Mechanical and electrical's turnover decreased to 516 million rand when compared with a 581 million rand in August 2018. The operating loss of 33 million rand has been impacted by the following. Project losses. Oil and gas incurred a loss on a petrochemical project. This project is complete. Mechanical incurred a loss on a surface mining infrastructure project. This project is complete. Historical arbitration. The arbitration matter relating to the cancellation of a petrochemical contract has been postponed due to a fundamental change in the client's defense. At this stage, the financial impact thereof cannot be quantified. Percentage turnover and order book by sector. 63% of the current turnover was in surface mining and related services. In the current order book, 82% is made up from work in the industrial plants and oil and gas sectors. Opportunities exist in the traditional petrochemical sector with the release of a number of tender inquiries in preparation for the clean fuels projects, which are anticipated to come to market next year. The previously delayed tank farm projects are expected to come to market in the medium term. Ongoing plant maintenance offer opportunities for the oil and gas and electrical and instrumentation divisions. Currently, there is a shortage of work of surface mining plant infrastructure projects, which is negatively affecting the mechanical division's order book, both locally and cross-border. In the short term, there are potential awards to the value of approximately 745 million rand, and for the next 12 months, projects to the value of approximately 4.2 billion rand have been identified. This slide is a consolidation of the business unit's actual turnover and current order book by sector. 31% of the order book is secured from outside South Africa, including the UAE. Less than 20% of our turnover in South Africa comes from the public sector, consisting of bridge construction, energy generation, and water and sanitation. Public sector work outside South Africa mainly comes from Botswana and Swaziland. In the short term, there are potential awards to the value of approximately 7.8 billion rand, and for the next 12 months, projects to the value of approximately 46 billion rand have been identified. I have already covered the actual performance of the business units earlier in this presentation. However, with respect to the next 6 months, construction and mining, we expect to have a similar turnover as to the current period. The operating profit margin for the next 6 months is anticipated to be similar to that as reported at February 2019. Building, excluding the UAE, we expect to have a similar turnover as to the first 6 months with no change to the operating loss. UAE operations contribution is expected to be similar to that of the first 6 months. Mechanical and electrical, we expect to have a similar turnover as to the current period with a slight improvement to the current reported operating loss. From a group perspective, for the full year, we expect turnover to be slightly down to that reported for February 2019. The operating loss is expected to remain similar to the current period due to the incurring of extraordinary advisory fees which will offset the various business units' improvement. I would now like to hand you over to Antonio for the financial overview.
Thank you, Russell. These results are in line with the trading update released on SENS on the 21st of November, indicating earnings and headline earnings per share to be a loss of between 600 cents and 640 cents. These results are characterized by the following factors as highlighted by Russell. So in summary, a trading environment that remains challenging, an additional IAS 37 provision raised for the public sector power project in South Africa, provisions raised for slow-paying receivables, project losses, and continued pressure on our working capital due to poor liquidity in the market and the funding of the large public sector power project results in the group continuing to experience short-term liquidity pressures. Some financial indicators: contract revenue, 4.4 billion, operating loss of 973 million, operating loss excluding the IAS 37 and slow-paying receivable provisions is 180 million. Headline loss per share of 608 cents and 134 cents excluding the provisions. Working through the statement of profit and loss, contract revenue for construction and mining, building, and mechanical and electrical decreased by 300 million, 280 million, and 65 million respectively, resulting overall in a reduction in contract revenue of 645 million. The EBITDA loss has been impacted by the raising of an additional IAS 37 provision of 462 million relating to the large public sector power project in South Africa. The group is actively pursuing its contractual rights in terms of the contract, and the raising of specific provisions for slow-paying receivables of 331 million due to less frequent and reduced payments being received from certain local and cross-border clients since the beginning of the financial year. The recovery of these amounts will continue to receive management's attention. With the exception of one of these debtors, none are in dispute. However, the timing of the recoveries remain uncertain. When they occur, they will positively impact on the group's performance and liquidity. And lastly, the loss-making projects as mentioned by Russell of 260 million. Due to less capex in the prior year, there's been a decrease in the depreciation charge to 106 million from the 113 million of the comparative period, which includes an IFRS 16 right-of-use charge of 24 million. This all results in an operating loss of 973 million. Should the IAS 37 and slow-paying receivable provisions be excluded, the operating loss is 180 million as opposed to the profit of 125 million of the prior period. The UAE operation contributed 15 million, which is more reflective of normal trading as opposed to the 38 million of the comparative period. Due to the liquidity constraints, interest earned has reduced to 17 million and interest paid increased to 59 million. This includes an interest accrual for the Kenyan tax authorities of 18 million. The tax charge is impacted by the IAS 37 and slow-paying receivable provisions, project losses, varying tax rates of cross-border jurisdictions, and the non-taxable contribution from the UAE operation. The group did not provide for a deferred tax asset on these provisions and project losses. In addition, an accrual for a potential tax liability in Kenya has been raised. The group entities operating in foreign jurisdictions are continuously subjected to tax audits by local revenue authorities as part of their enforcement processes. The Kenyan Revenue Authority is performing an audit on Stefanutti Stocks Kenya Limited for the years 2013 to 2018. An assessment has been received in September 2019 for the 2013 tax year for which an appeal has been lodged. The audit is ongoing and assessments for the following years have not been issued. The total value of the assessment, including interest and penalties, amounts to 43 million. Loss after tax for the period has been impacted by the IAS 37 and slow-paying receivable provisions. All this results in a headline loss per share of 607.72 cents. Excluding the IAS 37 and slow-paying receivable provisions, the headline loss per share is 133.56 cents compared to the profit of 60.30 cents of the comparative period. Moving on to the statement of financial position. On the asset side, CapEx spend for the period is 68 million, excluding 2 million IFRS 16 right-of-use assets. Of the traditional CapEx, 60 million is for expansion and 8 million for maintaining operations. Due to clients delaying the certification of work in progress has increased from 507 million at February 2019 to 604 million. This has also been impacted by a project undertaken by the Mozambique operation, where material on site and monthly work undertaken can only be billed once certain milestones have been reached. Part certification for this work has taken place in November, and payment is expected thereafter, with the balance of certification to take place before the end of January 2020. There has been a 3% increase in trade accounts receivable, with days in debtors having increased from 68 days at February 2019 to 77 days, which exceeds our target of 60 days. As mentioned earlier on by Russell, provisions have been raised for slow-paying receivables where payments are less frequent and have reduced in value since the beginning of the financial year. Ongoing discussions are being held with these clients to resolve these outstanding payments. With the exception of one of these debtors, none of the remaining amounts are in dispute. However, the timing of the recoveries remain uncertain. When they occur, they will positively impact on the group's performance and liquidity. Net cash on hand of 396 million has been impacted by delayed payments from customers and the temporary funding of the large public sector power project, which continues to impact on the group's short-term liquidity pressure. The group has entered into a short-term funding agreement with its lenders on standard terms and conditions applicable to this type of funding. Funding received to date is 120 million and 391 million. Cost of funding, excluding arranging fees, is at an effective rate of 13%. There is an additional funding requirement of 595 million. The funds received have been utilized to stabilize the operations in the interim, while longer-term, more cost-effective solutions are being considered and evaluated, including an appropriate capital structure. This allows the group time to resolve its contractual claims on the public sector power project. The group remains in discussions with its lenders to secure additional tranches of funding. The restructuring advisors will develop detailed turnaround restructuring interventions and initiatives, including assessing optimal internal operating structures. The restructuring plan, to be finalized within the next couple of months, will be considered by the board for approval. Shareholders will be updated as to the plan and the anticipated timing of the implementation thereof. Based on the successful implementation of the restructuring plan, a favorable outcome on the process being undertaken as to the large public sector power project, and raising additional short and long-term funding, the group is deemed to be a going concern. Total interest-bearing liabilities have increased from 637 million at February 2019 to 774 million. This includes 39 million of IFRS 16 rental plant assumed liability, VRP obligation of 100 million, 132 million of specific ring-fenced project financing, which includes the deferred costs associated therewith, and approximately 127 million overdraft utilized by the Mozambique division. As mentioned earlier on, once payments are received on the milestone billings for that particular project, and the overdraft will be settled. The debt-to-equity ratio deteriorated to 103% from the 37% reported at February 2019. Equity has been impacted by the raising of the additional IAS 37 and slow-paying receivable provisions. Trade payables, accruals, and other current liabilities have increased from 2.1 billion to 2.2 billion as a result of extending payment terms to the group's suppliers and subcontractors. Excess billings over work done has in total increased by 77 million to 1.25 billion. There's been a 401 million increase in total provisions from 760 million at February 2019 to 1.2 billion, which includes the additional IAS 37 provision of 462 million. Moving on to the cash flow statement. Cash consumed from operation is 124 million, which is in line with the poor trading excluding the IAS 37 and slow-paying receivable provisions. A total of 379 million was invested into working capital as opposed to the 103 million of the prior period. Once again, I have split investing activities into the old way of preparing the cash flow statement, split between CapEx acquired to maintain and expand operations and other investing activities. A similar adjustment was made to financing activities with 2 million of net debt being raised during the period. All in all, there's been a reduction in cash from February 2019 of 485 million to 396 million. In conclusion, from my side, resolving the short-term liquidity issues and focusing on a positive resolution with respect to the large public sector power project remains the top priority. I now will hand you back to Russell to close the presentation.
Thank you, Antonia. Industry-related matters. With respect to the civil claim received from the City of Cape Town for the Greenpoint Stadium, a trial date had been set for the first quarter of 2020. However, on request of the client, this trial has been postponed. The group remains confident it can defend this claim. The group continues to be negatively affected through disruptive and unlawful activities by certain communities and informal business forums in certain parts of South Africa. In summary, we'll continue to focus on securing the necessary additional short and long-term funding, pursue a favorable outcome from the processes being undertaken on the large public sector power project, drive the collection of all outstanding slow-paying receivables, renew our focus on the reduction of loss-making projects, drive the development and implementation of the restructuring plan, and return the group to profitability. In conclusion, with respect to the large public sector power project, as you're all aware, this is a highly complex project. Funding is required to provide sufficient time to enable us to resolve our contractual claim. Any form of resolution will positively contribute to the reduction of overall debt. The potential of asset disposal and debt recovery will also contribute to the reduction of overall debt. With the exception of the Van Gakfontein mining project, there are no other significant loss-making projects in the group. We have identified approximately 46 billion rand of prospective work. This brings us to the end of our presentation. We would like to thank you for your participation in our webcast. We now go into the question and answer session.